Why is Nikkei 225 hesitating at 69,500, while the weekly trend screams strong buy? This Japan stock index forecast unpacks the hidden pivot resistance, the support levels that hold the key, and the AI melt-up scenario that could trigger a 1,000-point rally. Right now, the Nikkei 225 is sitting at 69,468, less than 80 points below the most dangerous pivot of the month. Most traders see a strong weekly trend and think they can just buy blind. But what I see is a trap at 69,546 that could spring a violent short squeeze or a stop hunt that flushes out the late longs. There is one danger zone and one hidden opportunity right now. I'll show you both. Stay to the end. I'm giving you 2 scalp plays and 1 swing trade you can execute today. On screen now, 69,546 trap, 2 scalps plus 1 swing. Here's my session buys for the Nikkei. We are range-bound with a bullish underlying tide, but the short-term charts are screaming exhaustion. The monthly and weekly trends are a strong buy. No debate there. The daily is still a buy, but the 5-hour and 1-hour have both flipped to neutral. That means the immediate flow is sideways, and whoever tries to force a breakout right now is going to get chewed up. The single invalidation level that changes everything is 69,200. Write this number down. If we break and close below 69,200 today, the entire short-term structure resets and we are talking about a deeper correction into the 68,815 MA20. But if we hold above it, this is just a consolidation before the next leg higher. The herd is positioned long from the Tokyo Open, expecting that the AI narrative just keeps lifting chip names. When everyone is leaning one way and the 1-hour stochastics are pegged at 95, the market has a habit of shaking them out first. That's where we hunt. Let me walk you through the canvas from the top down. On the weekly, the Nikkei is a fortress of bullish momentum. Price sits well above the MA20 at 68,815, the MA50 at 65,613, the MA100 at 62,004, and the MA200 way down at 56,816. Every single long-term moving average is sloping higher, and the MACD histogram on the weekly is still expanding positive. That is the tide. It's not something you fight. Now drop to the daily. The daily trend is buy, but it's losing its breath. The ADX at 27 tells me the trend has power, but the CCI at -57 and Williams percent are at -5.2 both indicate a short-term overbought condition that has already started to correct. The MA5 at 70,049 and MA10 at 69,705 are both above current price, so the quick momentum has rolled over. However, the MA20 at 68,815 is holding as the dynamic support. That's the floor everyone is watching, and because everyone is watching it, the real liquidity might be lower or higher. On the 4-hour chart, we've carved out a tight range between the pivot point at 69,732 and the first support zone around 69,452. Price is currently 69,468, hugging that lower support. The MACD on the 4-hour is curling but hasn't given a clear cross yet, and the RSI is neutral at 54. Here's what most traders miss. The real hidden divergence is on the 1-hour chart. While price has been making lower highs since the Monday peak, the MACD has been making higher lows. That's a bullish divergence building in the shadows, but it's not confirmed until we break above the 69,546 level, which is the S1 pivot and the immediate trap. So we have this tension. The long term says buy, the short term says wait, and the 1-hour divergence says a snap higher is lurking. My support levels are exactly 69,452 as the first intraday floor, then 69,266 as the secondary. Resistance starts at 69,546, that's the pivot-derived trap, then 69,826, then 70,012. Crosser set. Keep your eyes on US dollar to Japanese yen. A falling yen is fuel for the Nikkei. A sudden yen spike on BOJ intervention whispers would instantly take 300 points off this index. So I'm watching the 145 level on dollar yen like a hawk. Also, S&P 500 futures overnight have been grinding higher, and that correlation has been 0.8 this week. If US futures roll over, the Nikkei will feel it. The 24-hour news flow is thin, but the structural story is everything. The headline says Japan stocks higher at close, Nikkei up 0.23%, but the real driver is the analyst note crossing the wires. Tokyo has hitched itself to Seoul's AI rollercoaster. That means the Nikkei's heavyweights, Tokyo Electron, Advantest, Lasertech, are trading not on domestic data, but on the global AI semiconductor order book. When Samsung and SK Hynix rally in Seoul, the Nikkei catches the wake. That is the RE proxy momentum machine we are riding, and it's both a blessing and a risk. The 1-2 week directional lean. I am still structurally bullish as long as 69,200 holds. The event that invalidates that bullish lean completely is a daily close below 69,200, which would open the trapdoor towards the 68,800 MA20. On the upside, a clean 4-hour close above 69,732 pivot opens the melt-up path to 70,100 and beyond. The macro web you must track is this. If US tech earnings continue to guide AI capex higher, the Nikkei semiconductor names will break out first, and the index will follow. If the Bank of Japan does anything hawkish or the yen strengthens suddenly, the whole trade gets a shove lower. So my playbook is long but disciplined, with exact levels. Second interaction trigger. Do you think the Nikkei reclaims 70,000 this week? Comment yes or no. I'm tracking consensus right now. Most people skip this section. That's exactly where the money is made. Keep watching. I'm laying out 2 scalps that exploit the trap and 1 swing trade aligned with the weekly trend. Every entry has an exact price, a stop, and a risk reward. This is the institutional blueprint you run before the open. Strategy 1, the opening scalp, scalping, high probability. This first one capitalizes on the immediate liquidity resting just below the 69,452 support. When the Tokyo equity session opens, we often see a quick stop run below the obvious level to collect the early sell stops. That's our sniper zone. The trigger. Price taps into the 69,450 to 69,440 band and prints a bullish engulfing candle on the 5-minute chart. That's our entry, ideally at 69,445. I'm not placing a limit order. I want the confirmation of the engulfing close before I step in. The stop loss goes at 69,400. Tight, 45 points below entry, just beneath the wick. Take profit once it's at 69,540, just shy of the 69,546 trap. That gives me about 95 points of upside for 45 points of risk, a clean 1 minute and 2.1 second risk reward. If momentum is fierce, I'll let a second lot run to take profit 2 at 69,620, collecting the liquidity above the first minor resistance. What instantly voids this scalp? If the 5-minute candle that taps the level closes as a bearish Marubozu, no tails, then the support is breaking, and I stand aside. No heroics. The opening SCLP entry, 69,445, 5M bullish engulfing after tap of 69,45069,440, stop loss, 69,400 take profit 1, 69,540 take profit 2, 69,620 risk, reward, 1:2.1 are invalidation. Void if 5M candle closes below 69,440 without bullish engulfing. Strategy 2. The liquidity grab, scalping, counter noise. This one flips the script. The trap at 69,546 is so obvious that breakout traders will pile in the moment it breaks. Their stops sit just above, and the market loves to trigger those before reversing. Here's how I play the stop hunt. We wait for a fake breakout above 69,546. Specifically, price spikes through 69,546, grabs the stops up to the 69,580 to 69,600 region, and then, within the same 15-minute candle or the next, closes back below 69,546. That is the rejection I need. Entry is on the close below 69,546. typically around 69,540, short. Stop loss is placed at 69,600, just above the high of the spike. My target is the nearest intraday liquidity pool, 69,460, which is the support just above 69,452. I'm taking profit there, swift and clean, roughly 80 points of gain for 60 points of risk, a 1-minute and 1.33 seconds ratio, scalp territory. Warning: this requires fast execution. If the 15-minute candle stays above 69,546 with a strong body, we are not fading it. That would be a valid breakout and the melt-up is on. Do not fight a true momentum surge. After that, I want to hear from you. Are you scalping or swinging this week? Comment scalp or swing. I want to see where this community sits. The liquidity GROB entry, 69,540, short, after 15 minutes closed back below 69,546 following spike to 69,580 plus, stop loss, 69,600 take profit 1, 69,460 risk, air reward, 1:1.33 are invalidation, void if 15M candle closes strong above 69,546 without rejection. Strategy 3. The session swing, trend alignment, now the swing trade that lets you hold for days, not minutes. This is the one aligned with the monthly strong buy. The trigger is built around the 4-hour chart reclaiming momentum. I want to see a 4-hour candle close above the MA10 at 69,705, accompanied by a bullish MACD cross on that 4-hour time frame. That combination tells me the short-term neutral phase is over and the trend is resuming. Entry will be on the close of that candle, around 69,720. Stop loss is placed below the daily structure at 69,150, well beneath the critical 69,200 invalidation level, giving the trade room to breathe through noise. That's about 570 points of risk. Conservative take profit 1 sits at 70,100, the R2 resistance, capturing 380 points. That's a 1-minute and 0.66 seconds risk reward on first target, but the probability is high. The stretch take profit 2 is at 70,600, a level that coincides with a measured move from the prior range. That would yield 880 points. Once price reaches halfway to TP1, around 69,900, I move my stop to break even. I then trail the stop using the 4-hour MA10 as a dynamic level. The explicit invalidation that would kill the medium-term bullish outlook entirely is a daily close below 69,200. If that happens, this swing is off the table and I flip to a neutral or short bias. This is the trade that captures the AI melt-up if Seoul keeps running. The session STRNG entry, 69,720, for H close above 69,705 MA10 with bullish MACD cross, stop loss, 69,150 take profit 1, 70,100 take profit 2, 70,600 risk, reward, 1:0.66 R, TP1, 1:1.54 R, TP2, invalidation. Swing void if daily close below 69,200. Never risk more than 1 to 2% per trade. On these Nikkei scalps, with an ATR near 1,900 points, even a small position size can move fast. Scalps demand even tighter risk. I size them so a stop-out costs less than 0.5%. No positions through high-impact news like the Tokyo Fix or US ISM. Stops are non-negotiable. This is how you survive to trade the next big move. Here is the one level you tattoo on your screen for the next session, 69,200. If the Nikkei breaks and closes below 69,200, the whole monthly trend gets called into question and I will have a completely updated blueprint for you 24 hours from now. Tomorrow I'll be watching the Tokyo Open reaction to the US close and any fresh AI capex headlines out of Seoul. That's the wildcard. If you want the full breakdown on Bitcoin and the S&P divergence, that video is live now. Tap the end screen to watch next. The AI risk asset shadow is driving everything, and that video connects the dots. Hit the bell so tomorrow's alert lands before the cash open. Hold the like button and subscribe. Every signal helps the algorithm bring you the levels that matter. End with silent on-screen text. Scalp the noise. Swing the trend.